Hi, I'm Peter Rose, founder of Longwood Currency Trading. How to get your trade entry right. If you're trading Forex, the process is even more critical that you get that right because of the leverage that we have, right? So your mistakes are going to be amplified as well as your when you get the decision correctly. The problem is if you don't get the decision correct. And that's based on your win-to-loss ratio, not your win rate that a lot of people talk about. And so when I'm working with someone in trying to resolve their problems, most of the time the problem comes because of poor entry analysis. When I have worked on all of these videos and published all these videos for you folks, one of the themes that runs consistently through them is what I call the life cycle of a currency position, which is a rip on my 33-year career as a senior software engineer, where we followed what's called an SDLC, a software development life cycle. It's a process of solving complex problems. And so I brought that into the currency market and found that what we're really looking at is a currency position. Now that's really what we're managing. When somebody throws the ball to us, that ball is a currency pair. It's a position that we either bid ask. And there are three phases that position is going to go through that we're going to have to solve. Each one of those phases is a problem. So there's three problems that need to be resolved in the life cycle of a currency position: entry analysis, position management, and exit methodology. And if you don't get the entry analysis right, you're not going to have a position to manage and you don't have anything to get out of. So you've got to understand how to get your Forex trade entry right. You got to get that analysis correct. And it's one of the most difficult things that I have in trying to take a trader who's been going along for a while and listening to all this noise that's out there and try to get them to back up and look at the problem that you're trying to solve. Entry analysis. What are you trying to solve? Well, you're trying to solve two things. One is, do I have an entry? And number two is, if I make that entry, how am I going to benefit from that? What's the magnitude of the benefit? Now, we could all say, well, the first thing you have to do is set your stop and take care of your risk. And I guess for most people that aren't able to break the problem down and look at it realistically, that's probably the case. In my case, and the stuff that I share with the folks that listen to me, is that's immaterial. The risk of the trade is immaterial. That's not something that you want to be trying to figure out during your entry analysis. The entry analysis has to be a positive thing. If there's no potential gain within the parameters that you have of what a gain would be, that would be your profit target, for example. If you don't have a valid profit target, then you're wasting your time thinking about and worrying about your risk. Risk is not part of the entry analysis phase of the life cycle of a currency position. That's something that's done at a framework level, at a market level. I mean, this stuff is being pulled out of courses that I have in consulting, kind of out of context for you to really understand. Because when I work with someone, it's on a personal basis, and we go through these things in depth. It takes time. But if you take a little bit of time in the beginning, maybe a couple of weeks, then the rest of it goes because you've built a foundation. When you're going to build a house, you spend a lot of time building that foundation. Watch a house go up. It takes a long time to get that foundation dug out and spec'd out and everything all set for the size of the house that's going to be built. Once the foundation is on there, the framers come in and the building goes up fairly quickly. Because the plumbing's in there, The electrical feeds are in position, and all you need to do is build on that. And that foundation level stuff is not part of your analysis of whether you're going to take a trade or not. That already has to be done. You already have to know that, so that you can build on it very quickly. And that's why, I mean, I get a lot of blowback from people that say, oh, how, you talk about coming down in the morning and turning the trading platform on, and you're brushing your teeth, and you look and you say, oh yeah, there's an opportunity there, set a couple of limit orders and go in and finish the brushing your teeth, or maybe you just take the trade and walk away, and sometimes it takes 20 or 30 minutes or 45 minutes for the trade to kick off. Sometimes it kicks off and it flounders around a little bit, and it might take an hour or so to actually come to fruition. I don't know, I'd say maybe 70% of the trades are like that. You kind of have to wait for them to happen. But if you've done your analysis correct, you can have confidence in letting it sit there while you look at CNN or somebody else's website, or read emails or whatever, while that trade goes about doing what you had thought that it should. But that entry analysis stage is so critical in making the probabilistic determination if there's a valid profit target. And then there are certain conditions that I talk with folks about as to the probability of whatever the price action is, what's that probability of it getting to the profit target? The fact that you've identified the profit target doesn't mean that the price is going to get there. The profit target is only the conditions are there such that if there's no logs stretched across the road, then the car should be able to get from point A to point B. Price should be able to get from entry point to profit target, as long as you don't have a lot of clutter along the path. That clutter is multifaceted and certainly more in depth than I could go into in a video, and it would be inappropriate as well, simply because there's a lot of information that I share with someone who I'm working with that builds a foundation of information, so they say, well, this is important to look at, and they go, oh yeah, I see that, and then they ask a question. They say, well, what happens if this is this way? And then we can discuss that, and the coursework tries to provide a written pathway for someone to go through all that, so that they have those questions and stuff, so that when we get together on a video chat or something to talk about whatever the assignment was, that the questions that the person has about that particular section, if they don't ask those questions, I'm going to say, gee, maybe you should go back and take a look at that section again, or you should reevaluate maybe the step that we talked about before, because you're missing asking a question that I would think that you should ask about this stuff, because you see something that has been triggered in your study or your discussions with me. That's the educational process, not following somebody's signal service or some engulfing candle pattern, or what happens when the Bollinger Band is in confluence with the RSI, or just all this crazy stuff that has nothing to do with trading itself. So how to get your Forex trade entry right? First of all, you have to understand that that's the most critical phase of the whole thing. Second of all, the focus is on the profit target. If there's no viable profit target, and there are conditions that you look at in current price action, whether you're on a daily chart or you're down on the 1 minute, it doesn't make any difference. There are conditions that have to be considered as to the viability of that profit target, and whether the price action in its current form, as it's beginning to manifest itself, and moving in the direction of the profit target, what's the likelihood or the probability that there's enough order flow there in order to get that price to move from where it is to where you want it to get to? And particularly for a day trader, I don't want to sit at my desk and trade all day. I want to be 1 or 2 hours of work. Now that trade may run all day, but there's stops in place and all that. The thing is set up. I would prefer that if I'm right, then that trade should go in 20 minutes. Now, it might take, from the time that I look at it and set my parameters, it might take 20 minutes for that to hit. But once it hits, if I've done my analysis right, in other words, those conditions of a price action that indicate that price will go to your profit target, if you're a day trader, you need to know they're going to go from the time that order hits until it gets to that profit target, or at least it gets far enough along the journey where you can say, it doesn't look like it's going to get all the way to the profit target, I'm out. And you've cleared enough as a percentage gain divided by the risk to equal some of the trading metrics that you've calculated that your trading is capable of. And then you measure that trade, and then you could look back at the entry analysis that you did, and you could say, well, this is where I had the strength in this trade, that I got X amount of percent, and it's not a 2% gain on the trade. You might get a 1.1% on a failed trade, or 0.2% on a failed trade. And you might get 0.8% on a trade that goes all the way to fruition if you get a long run on a trade. Or maybe you get a runner and it goes beyond your expectation. As a day trader, we have to prepare for that. We want to be sure that if we're going to enter a trade, let's say we have a 2-hour window before we have to go to head off to work. So we're going to get in there at that point in the beginning and find that trade. If that trade's not there, we'll go to work and get there 2 hours early so you can get off work 2 hours earlier. I mean, I just did a video on I'm not trading today because I don't want to. I don't see anything that's there. If you force yourself to find trades, believe me, you'll find them. They're not going to be strong because you're going to find a reason to put that trade on. Oh, it's Tuesday, or the Bollinger Band did this, or I need to get this so I can make my daily run for the day. You can't do that. That's not entry analysis. That's not how you go in to build a house. You don't show up on site and see the foundation there and go, oh, okay, I'm going to build I think I'll build a cape. Or you might go and say, slant roof contemporary, I think I'll do that. Well, all this stuff has to be thought out. All of it has to be conditional based. If I go to this particular kind of a foundation, I can build a 3-story house. However, if I go to another foundation, it might only be conducive for building a ranch. Well, how about getting together at the beginning of all this stuff to figure out that you want to build a ranch, and so you design the foundation for that? My foundation is built for a day trade basis. I may be looking at the 4-hour chart for some parameters for my entry analysis, but I'm down on the 5-minute chart trading. I'm setting my limits if I'm going to set limit orders up instead of doing just hitting a market order. I may be running into the conditional aspect of a rule that sets the parameters for doing certain things during that entry analysis stage. Not to get too off target here, but we are talking about rules. I have 3 rules, 3 simple rules, and I teach those. I have a rule for entry analysis, I have a rule for position management, and a rule for exit methodology. Now, within those rules are 2 to 4 conditions that need to be met in order for example, an entry event to warrant taking bid ask. Okay, so I have a rule that says my entry rule is to get into the trade based on a good profit target, and then here is a series of conditions. Now, those conditions are what we call extensible. The rule is extensible. The conditions set out parameters for maybe an ATR or whatever. And based on what's happening with current price action, you would need to say, okay, this condition falls within these parameters. This condition falls within these parameters. Because when I teach rules construction to a student, one of the things that we talk about in addition to the extensibility of the rule are the boundary conditions that the rule is trying to solve. And so that the extensibility and the boundary conditions are all the moving parts of that rule. You can't have a static rule. The stuff that people talk about all the time, engulfing candle patterns or pin bar patterns or flag patterns, or where, when the price jumps out of the flag and comes back and touches and then it heads back, okay, then you do this. Those are static condition parameters, and they break down when market conditions change because they're not extensible. And so you have a lot of stuff that works great, for example, in a trending environment and not so good in a chop. My rules work whether you're scalping or whether you're doing a long-term trade because they are extensible and their conditions are malleable to the current price action problem that I'm trying to solve. And that sounds complicated, but it's not. The complicated thing in learning how to swim is learning how to float and then learning the crawl, for example. Well, once you learn the crawl, then somebody could say, we want you to go into butterfly race. We want you to go into the backstroke race. And you go, well, how do I do that? Well, you do this, and then you can start practicing for that. And it won't take you as long to learn the equivalent skill that you have in for example, in crawl to backstroke. In fact, you may find that you're better at backstroke than crawl. And so we do the same thing during that entry analysis phase of the life cycle of a currency position, where we're looking at the extensibility of the rule and we're looking at the conditions that the rule is executed upon, and then we just look at it and we can at that point can intuitively say, without even going through a checklist of stuff, oh yeah, I'm going to do this. I'm going to wait 3 pips before I take this, or I'm going to wait 6 pips because it's probably going to come back and it's probably going to do this, but under the parameters of the current price action within the last 10 bars. On a 5-minute chart, that's 50 minutes, an hour. So what's going on in the last hour? Well, it depends on what part of the day you're in. If you're at the end of the main cycle of when the 2 country pairs are getting ready to go to lunch or shut down the shop for the day, your probability of success isn't going to be as high. And so therefore that condition, that entry condition may say, if you're at the end of the day, don't stretch for a 10-pip run. Make it 3 pips and go in heavy. But that's the extensibility of the rule. So how you get your Forex trade entry right is totally dependent on your understanding of the problem you're trying to solve and on the type of rule that you create. These are things that I work with in detail with students, and I don't have many students. I don't want many students because it takes my time to work with them. I'm just not handing them a PDF file and a bunch of videos and say, good luck. That's not the way that it works. If you're looking to replace your job income, you need to do it that way. If you say, look, I just want to do this as a side and I want to make a couple of $1,000 a month, or $500 a month or $200 a month to pay my electric bill. That's relatively easy. I mean, you're not going to do it on a $500 bank. You're going to need some money to do that. And so therefore, the training for that is to say, well, okay, let's try to get you 20% growth on whatever you have to risk. I have a $10,000 account. I'm going to make $2,000 a year on that, $200 a month, $150 a month. That pays the light bill. That pays the electric bill. And that's fine. That's doable. But if someone says, I want to take my $10,000 account and replace my job income, or take the $10,000 account and run it to $100,000, you're running with too much leverage. At some point, you're going to make a mistake. You're going to lose everything. So, and I tend not to work with folks like that. And I warn people. I don't have very many people that email me because if you're trading it at 200 or 500 or even 100 to 1 leverage, and you're not willing to change that, and you're looking for some secret sauce that will enable you to take advantage of that magic high leverage, and you see these people out there that are driving around in Lambos that are trading in 500 to 1, you're not going to be one of them. They just got lucky. They built up a big account, and they take small losses in the beginning. When they get a runner, they load it on, and they're trading at $200 a pip, and they make 20 pips, and it's a lot of money. So let's be reasonable about that entry thought process we're going through, so that if you do contact me, to help you, you have an expectation of what my general overall process is that I'm sharing with folks that are interested enough to listen to what I have to say, because it's not only proved out mathematically, and we do that in the coursework. We show you mathematically how this stuff should work. If the math shows that it should work, you should be able to implement it. And if you can't implement it, then we know exactly where to go in the recipe to fix it. But if you're not following the recipe, then we don't have a methodology to fix it when it goes wrong. And it always goes wrong because you're dealing in such a dynamic market, right? How to get your Forex trading right? Sit back, figure out the problem that you're trying to solve, and then develop the difference between a fixed set of framework rules and then your actual trading rules, which is your rules that deal with your entry analysis, your position management, and your exit methodology. But you better be sure that you're dead balls on accurate, as Marissa Tomei would say, and my cousin Vinny, on that entry analysis phase. Because if you don't have a good entry, you're not going to have a position to manage, and you got no position to get out of. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.